Friends, the age of paper wealth is over. From a financial standpoint, we're in an entirely new world now. In fact, we have been since 2022. It's just that most have not realized it yet. Let's go back to the start of 2022. Maybe you've just sat down at your kitchen table with a cup of coffee. You pull up your brokerage account on your laptop and you've done everything the right way. You've been diligent. You've followed the standard advice and you've been socking away money into your 401k for years. And into the target date funds that have become so prevalent with those things, because that's what Retirement Incorporated told everybody to do for a long time now. But then in 2022, interest rates started to scream higher. And suddenly your 401k funds are tanking, even though they are supposed to be balanced and diversified. The hard reality is that mainstream personal finance always assumed that interest rates would move lower over time. So when those rates went up, the target date funds that Retirement Incorporated had sold as the path to a comfortable retirement, they started going down. They weren't built for a world of rising interest rates. That's why 2022 was the worst year for Retirement Incorporated's 60-40 portfolio since 1937. That's telling, right? For the balanced portfolio, 22 was a worse year than 2008 with the great financial crisis. And it was worse than the 2001 dot-com bust as well. It was the worst year for the 60-40 portfolio. A lot of people got hurt, and most of them had no idea why it happened or why everything they were told to do suddenly didn't work very well anymore. And what did the financial media do? Rather than explain anything of substance, they pointed the finger at Jerome Powell and said it was the Federal Reserve's fault for raising interest rates so fast, as if it was all a targeted attack on people saving for retirement. Well, the reality is much more nuanced and a much bigger deal. And it all comes down to an arcane but fundamental change that most people have never heard of. Hello and welcome to episode 7 of the Phoenician League podcast. I'm your host, Joe Withrow. The first 6 episodes of this show were all about background, laying out my story and explaining how the Phoenician League came to be. Hopefully those laid the foundation so you can see how my perspective was shaped. Starting today, we're going to shift gears. Every week going forward, I want to bring you market analysis and economic commentary that you're probably not going to get anywhere else. And that's because I'm an open book, and I have no underlying motive here. But I do have a unique view on what's been happening at the macroeconomic level, and I think understanding the big picture can be a big help for people who are trying to build real wealth and create true financial security. So today, we're going to drill into the plumbing of the American financial system. We're going to talk about interest rate benchmarks, one called LIBOR and one called SOFR. And I'm going to show you how these arcane rates deep within the system's plumbing have everything to do with our world today. Now, please bear with me because I know this kind of thing might sound dry, but I promise you, this is one of the most important stories in finance over the last 4 decades. Yet I don't see many people out there talking about it. So we're going to focus on that story, the big picture. We're not going to get bogged down in the weeds of the technicalities. They're just not important. So let's start here. For the last 40 years, what was called the London Interbank Offered Rate, or LIBOR, was the most important interest rate in the world. It was the foundation of the global financial system. And that's because hundreds of trillions of dollars worth of financial contracts were priced off LIBOR. We're talking mortgages, we're talking corporate loans, student loans, credit cards, various options and derivatives, you name it. If money was borrowed anywhere in the developed world, there was a good chance that LIBOR had some impact on the deal. So LIBOR was our primary interest rate benchmark. That means a small move in LIBOR could affect borrowing costs for consumers, for businesses, and for governments across the globe. Okay? But the key question is this: how was LIBOR set? How was the rate calculated? Well, that's where the story gets interesting. So every day, a panel of major global banks with offices in London, we're talking the big names like Barclays, Credit Suisse, Deutsche Bank, UBS, JP Morgan, Bank of America, HSBC, Citigroup, I think there's a few others in there. These guys would each submit a number every morning. And that number represented what they estimated they would pay to borrow money from another bank on an unsecured basis with no collateral involved. So they submitted a number that was supposed to be their best estimate, right? But do you see the problem there? They weren't aggregating any real data from real transactions. They weren't looking at loans that had actually happened. No, they just submitted their numbers for interest rates every day, and that's it. Then the top and the bottom submissions were thrown out, and the remaining numbers in the middle were averaged together. And that average became the LIBOR rate for the day. And this happened every single day for nearly 37 years. All right, so that's how the most important interest rate in the world was determined, by a handful of big banks submitting a number and telling the world just to trust them, that it was the right one, and that they didn't have any ulterior motives. How crazy is that? Now, you can probably guess where this is going. In 2012, the story broke that several of those big banks had been manipulating their LIBOR submissions for over a decade at least. They would submit artificially low numbers to make themselves look financially healthier than what they were. Or they would coordinate with traders to kind of move the rate in whichever direction helped their derivatives books on any given day. And they would collude between other banks and brokers to make sure that the LIBOR rate went the way they wanted it to. So Barclays was the first to settle, then Deutsche Bank, then UBS, then some of the others. By the time the full extent of the manipulation was understood, it had affected literally hundreds of trillions of dollars of contracts. These are, things that affected people's mortgages, people's loans, people's retirement savings. All of them were priced or impacted by a number that had been quietly and systematically gained by these big banks in London. It's one of those stories that just confirms what a lot of people already suspected about how the financial system actually works. And the official response was largely to slap some wrists and collect some fines and then kind of move on, right? But that was it. The scandal largely faded away pretty quickly because the entire edifice of the global financial system had come to depend on systematically lower interest rates, right? And that's due to offshoring, due to globalization and financialization. So that was the age of paper wealth, and LIBOR was its useful tool. But in April 2018, a silent coup of sorts appeared to unfold. That's when the New York Federal Reserve began publishing a new interest rate benchmark. It was called SOFR, the Secured Overnight Financing Rate. I don't recall seeing any fanfare around this at all, because at first it just appeared to be some technical experiment coming from deep within the depths of the Fed, right, which itself was known to manipulate interest rates routinely. So it wasn't perceived as a threat to LIBOR, not at first anyway. But the Fed gradually phased SOFR in over the next several years. And starting in 2022, it became the primary interest rate benchmark here in the US. That ensured that all new loans and contracts were based on SOFR, not on LIBOR. Then on June 30th of 2023, the last LIBOR rate was published. After that, LIBOR was officially dead. So in hindsight, it's easy to see that SOFR was a revolution of sorts. It was a shot across the bow, signaling that a new financial era was upon us. Those who recognize that have the opportunity to do very well from an investment perspective. To understand why, we have to first understand how SOFR is fundamentally different from LIBOR. And it starts with this. SOFR is not an estimate. It's not self-reported. Instead, the rate is calculated based on actual transactions in the U.S. Treasury repo market. So this is real money that actually changed hands between self-interested economic actors in the marketplace. So no estimates, no submissions from banks, which means there's no room to gain the rate. It's fundamentally a market-based interest rate. And SOFR reflects secured transactions, which can't be spoofed. So these are transactions that are backed by U.S. Treasuries as collateral, meaning you have to post real assets, U.S. Treasury securities, to participate in the marketplace. If you don't have the assets, you can't participate. So in LIBOR's world, the rate was based on unsecured lending, which means you didn't need any assets to play the game. In SOFR's world, you need something real. So the transition from LIBOR to SOFR is, at its core, a transition from a system built on self-reporting and manipulation to a system built on verified transactions and real collateral. While nobody in the world seemed to notice, we went from a financialized system based on paper to a collateralized system based on substance and market activity. So by the start of 2022, when SOFR rolled out in full, the message was unambiguous. Banks were no longer permitted to enter into new contracts using LIBOR. The old rate was technically still being published to service legacy contracts, But for all practical purposes, LIBOR was being phased out, and its financialized architecture was being replaced. All right, with that in mind, what was the biggest financial story of 2022? Easy, right? It was Jerome Powell and the Federal Reserve raising interest rates at the most aggressive pace in history. From March of 2022 through mid-2023, the Fed raised rates, I believe it was 11 times. The federal funds rate went from effectively zero, from the floor where it had been sitting for most of the time since 2008, and it went all the way up to 5.25%. Now, while the top line number there, 5.25%, that's not eye-popping, but this was the fastest, most aggressive rate hike, in a rate hike cycle, I should say, in 40 years. Now, the media told a very specific story about why this happened. They said it was all about inflation, right? That Powell had to raise rates to fight inflation. That was their narrative. And sure, inflation was a problem. But structural inflation has been a problem for a long time now because we've been running our system on pure fiat money since 1971. So I would suggest to you that there was a deeper story behind the Fed's aggressive rate hikes in 2022. And it has everything to do with the rate transition we just talked about. Think about this. For nearly 40 years, the global financial system ran on LIBOR, an interest rate that was set in London by a panel of global banks on an unsecured, self-reported basis. The Fed could set the federal funds rate all it wanted, but that rate only impacts the rate at which banks borrow from one another overnight. The rate that actually touched people's mortgages, their loans, their retirement accounts here in the US, that was a rate that was ultimately controlled by a handful of banks in a city across the Atlantic Ocean, right? So in that world, the United States never really had full control over its own monetary policy. Because if the Fed were to hike the Fed funds rate, but the global banking consortium, if they didn't like it, all they had to do was manipulate LIBOR lower at the same time. And in that doing so, long-term rates would not rise across the economy. So they could kind of offset anything that the Fed did. But SOFR changed that. In a very real sense, it was the reclamation of American monetary policy. So here's the question I'll propose to you. Why do you think Jerome Powell waited until 2022 to start aggressively raising interest rates? Why didn't he start sooner? I mean, consumer price inflation started ramping up early during the COVID hysteria. And to me, the answer is obvious. He had to wait until SOFR had been replaced by LIBOR, or else the global banking cartel could have just at least partially thwarted his efforts because they controlled LIBOR. So I don't think the timing was a coincidence at all. I also don't think that the Fed's rate hikes were just about fighting inflation, which again, that's what the financial media blasted 24/7. No, I think it was a signal. It was a signal to the global financial system that the United States was reclaiming its own economic sovereignty for the first time in a very long time. And that's not just conjecture on my part. I remember the United Nations put out its annual Trade and Development Report in October 2022, and it strongly criticized the aggressive rate hikes that major central banks were taking. Then it attempted to highlight how those rate hikes were harming developing countries, right? So this is in October 2022 as this cycle is really ramping up, right? So the UN paper, it offered a definitive conclusion. It was very, very clear. All central banks need to halt further rate hikes. That's what it said, right? That appeared to be a message to the Fed. You need to stop. The very next FOMC meeting, Powell came out and hiked interest rates another 75 basis points. If my memory serves, I believe it was 75 basis points, right? So he completely bucked the global architecture. He completely said, no, we're not playing your game anymore. So guys, we've been witnessing a financial war here. It's been a war between an American sovereigntist faction and the faction that controls all these globalist intergovernmental institutions that have been created since 1944. Now, no media outlet has ever reported any of this as such. But if you ignore their headlines and actually look at what's happening, you can see the breadcrumbs and then you can connect the dots and it's clear as day. That's why things have appeared to be so chaotic at the macroeconomic and at the geopolitical level. We're in the middle of a financial war, except nobody knows about it because the war is being fought between unnamed, unofficial factions, right? It's not a war of country versus country, which is something that we can see and understand. It's something completely different. Now, let's bring it back full circle here. For 40 years, from 1982 to 2022, interest rates had been on a long, slow mostly downward path. Of course, there were bumps along the way. There were spikes in there intermittently, but the overall trend, the general direction of interest rates was down. Year after year, decade after decade, just constantly fell for 40 years. And as interest rates fell, borrowing costs decreased and the value of bonds increased. And as borrowing costs decreased, credit became easier and easier to attain. And so we saw governments, corporations, and regular people just gradually take on more and more debt. And again, the numbers spell this out. If you were to add up total debt across the government, corporations, and all household debt, it was around 150% of GDP in the early 1980s. By 2022, total U.S. debt was 350% of GDP. Now, to be fair, GDP is a very flawed metric, but still, the data shows that debt soared much faster than actual economic activity. Meanwhile, we offshored our industry here in the United States, and we financialized everything that could be financialized, meaning we shifted the economy away from making things toward a system built on debt, on leverage, securitization, derivatives, and financial engineering. So companies started to focus more on stock buybacks and financial trading and kind of balance sheet gains rather than on long-term investment in factories and research and development and building out a strong employee base. As a result, banks and financial markets became the center of the economy instead of manufacturing. We could do that because interest rates were constantly falling and credit was rapidly expanding. So the financial system became flush with liquidity, right? And that liquidity tended to chase asset bubbles. It chased dot-com stocks higher in the late 1990s, and that created a massive mania that then led to a bust. Then it chased real estate prices higher in the mid-2000s, leading to a major bust in 2008. And since then, that liquidity has chased passive index funds and various other financial assets here and there, and it's chased them higher. So that created a world in which the fundamental valuations of many investments became disconnected from the underlying real economy. Falling interest rates and cheap credit made that possible. That was the age of paper wealth. And Retirement Incorporated built an entire industry on that foundation. Mutual funds, the idea of financial planning, asset management, target date funds that automatically shift your portfolio towards bonds as you approach retirement. All of that was built on LIBOR-era assumptions that interest rates would fall and credit would be cheap. All of it was built for the age of paper wealth. But all that changed in 2022 when SOFR rolled out and the Fed decoupled American monetary policy from the global financial system. That signaled the beginning of a new era. Just nobody seemed to notice. So this begs the question, what does any of this mean for us? What does it mean for regular people who are just trying to make a living and secure their future? Well, I think it means a couple things. First, the world of artificially low interest rates is over. We're not going to be financing homes with a 2.5% or 3% mortgage ever again. That was a historical anomaly. We're not going back there because that was only possible in a world tied to LIBOR, which was a gamed rate. The new architecture is different. The new architecture is built for a world where collateral matters, where real assets matter. And that brings us to my second takeaway, and that is the concept of asset allocation will be far more important in the decades to come. Asset allocation refers to building out a portfolio across different assets, gold, Bitcoin, stocks, max funded life insurance contracts, mortgage notes, real estate, royalties, you name it. Retirement Incorporated made a living telling people that being diversified meant owning a mixture of stocks in different industries with maybe some bonds thrown in. And then it created a bunch of different funds that people could stuff into their retirement accounts to accomplish this, to get diversified. But that's not diversification. That's fragility, especially in this new economic era. Asset allocation is true diversification, and it's about making your investment portfolio bulletproof. This is one of our foundational pillars at the Phoenician League. My third takeaway for you today is that real assets are reasserting themselves as we speak. Financialization and globalization are both being reversed right now. And that's why assets like gold, like Bitcoin, energy, and certain commodities also, they're all being repriced. In a world where collateral matters, your economy needs a base of real assets, not just paper IOUs. I know that's not exactly a groundbreaking idea, but I'm still amazed at how many people are out there just shoveling money away into index funds inside their retirement account. And they seem to still think that that's what they're going to retire early on. Personally, I think the entire concept of retirement is probably obsolete. And I'm not so sure it was a good concept in the first place. We can maybe talk about that more in a future discussion. But I'll leave you with this for today. I think the most important thing you can do right now, if you haven't already, is take an honest look at how much of your financial life is still built on assumptions from the old world. How much of your portfolio depends on low rates and cheap credit? And if you're not happy with the answer, we have plenty of resources available for you at PhoenicianLeague.com. Our entire investment focus is built for this new economic climate. We have tons of written insights that you can peruse at your own leisure on the site as well. Friends, we're in an entirely new financial era today. The bad news is that so many people just don't realize it. The good news is that for those of us who do, there are some incredible opportunities in front of us. As I pointed it out last week, we have it in our power to begin the world over again. That's going to do it for today's episode of the Phoenician League. If you found any value in today's conversation, please subscribe to stay plugged into the network. We put out new episodes every week. And if something we talked about today made you think differently about money or investing, please leave a review and let us know. That helps the show reach the people who could really benefit from it. And remember, financial freedom does not start with money. It starts with understanding and a fiercely independent mindset. So if you would like to dive deeper into the topics we cover, I invite you to get on the Phoenician League email distribution list at PhoenicianLeague.com. We often send out detailed written analysis on the various investment opportunities and the asset classes that we advocate, and we connect the dots across what's actually happening in the global economy. And then we host online strategy sessions periodically as well, where we can really drill into how to take full command of your financial future. So stay connected at PhoenicianLeague.com. And until next time, let's stay smart and let's stay independent. This is Joe Withrow, signing out.